Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter or X or whatever you want to call it now and talk about wealth building, financial topics, commodities, anything that I think is worth mentioning. I retweet it. We talk about real estate every once in a while, and I give my financial opinions across the board. If you want to follow me on Twitter, it's at finding_finance. You can kind of see that in the background there, right there. And I do have a website, finding-value.com. That's where we talk about individual companies, stuff like that. I can't give advice or anything like that, but I do go over a lot of the stuff I'm doing in my portfolio, the companies that I own. We are up a lot in a lot of the companies. Not everyone will be 100% absolute winner, but we've had some really good ones in the energy service sector, some in coal, in exploration, oil and gas are starting to pay off as we start to take on off. And you know, some people say, "Well, what's your return? What's the return of the?" I don't have an equally weighted portfolio. It depends on what people weight these things at, and your returns are going to vary very big between individuals and how they weight the companies. If you're in there and you're weighting more cash flow companies, I would say that's a little bit more of a probability bet, higher probability of success. And if someone overweights uranium, they've been waiting for a little while. I think I think they know what the best companies with the most upside are. And if uranium takes off, it takes off. So it depends how people weighted their portfolio, what those returns will be, and how much risk they are willing to take on. I guess I don't have as much risk as maybe some of the other individuals. I'm more physical precious metals stacking, big time stacker there. And then I'm very big in oil and natural gas and energy service, but I've got my allocation to uranium. And finger crossed, hopefully we get moving soon in the uranium sector. So let's dive in here. Let's see what's going on, and I'll share my opinion. So Peter Sutherland says triple digit oil is coming. Yeah, I agree. Market is effectively broken through end of September as return of 6.3 million barrels into SPR will hit just as the Kingdom of Saudi Arabia exports to HSC dry up in August, September. Record SPR dump in 2022 distorted the market signals, and the snapback will come at very high price. He is long. I'm long too. I'm actually extra long. Yeah, I've got a good chunk of my portfolio long in oil, energy service. I think we are going to go much higher over a long period of time. It says we're entering an era of resource scarcity, where our demand for energy increases while supply and those that know how to extract it are harder to find. For instance, there's a 75% decline in petroleum engineering degrees in the United States. We need more oil engineers, not dog walking apps. Well, you know what? The price is going to show that very soon. We're going to be triple digits. There's going to be a point, and I don't know when Saudi Arabia and some of these guys are going to kick back on their oil production. Hopefully, it doesn't get too out of control to the upside. We want a nice, slow, steady grind higher is what I prefer. Why do I prefer that? Well, I don't like the big pullbacks, guys. We don't need to go rocketing to $200 a barrel in a heartbeat. I know people think that's really cool. They think it's really, you know, I should say, dopamine hits of all these big moves to the upside. But I'd prefer a nice, steady increase. The companies I'm in, if they pay big fat dividends, perfect. Just pay me a bunch of dividends over the next 5 to 10 years. I would love that. Scrolling down, it says the median sales price for sold homes in the United States has dropped over 13% from quarter four, the 22 high of 479,500 to 416,100 as of the end of quarter two. Just rent it out, bruh. Yeah, bruh. So median sales price, you know what's happening? I think a lot of the homes are probably selling at the cheaper price levels, and a lot of the middle buyers who they own a home but they're gonna move up into another house. I just don't think that's happening. So, given the market conditions, we could see median or average sale price decline as new homes being built are going to be built and targeted for smaller homes and the new home buyers. And a lot of the people that are in the middle of the home buying sector, where we'll call them the move ups, a cheap house, moving, a cheaper home, a starter home or something like that, moving up to a larger house because their family's growing. I think a lot of people are delaying that due to the mortgage rates. And I've been even playing around. It's like, should I buy another house at some point and speculate on interest rates to some degree? Because if there's any sort of sign that we're going to roll over in interest rates, you could buy a house with probably the most amount of options today. You get in one, your payments will be high, and that's fine for me. I can afford it. And then I could rent it out. And then if I refinance it at a lower level, my profit margin would go way up. Now, I'm not going to do that this second, but if I were to see the interest rate were to really roll over, which I'm not seeing that, I'm not claiming that. But what I could do is get the most options today, get into something, and then I think it's just going to go haywire if interest rates go back down. But if you already own the home and you can refinance it, that would add another $1,000 a month to the bottom line, depending on where you could refinance and how you purchased the points down and all that stuff. I'm not going to do that. At least I'm not planning to do that, but I'll watch it and see what happens. Scrolling down, it says we have just experienced the longest streak of outflows from gold since November of last year, when the metal reached a bottom and rallied 26% in the ensuing months. This is a classic sign of weakness before a significant market move. Investors have been shaken up after a triple top resistance, although historically these formations almost never work. This is likely to unfold in conjunction with silver breaking a 15-year downtrend line and potentially moving substantially higher. A strongly compelling setup for precious metals to perform exceptionally well in the near term. So here we are. We're at a low here in terms of the streak of outflows, and we're at a good spot where probably be picking up some, doing some sprinkling in the precious metals, and that's exactly what I'm going to do. I know a guy up north. He's continuing to want to sell precious metals, and I'm basically just cleaning him out. If he wants to sell it, I'll buy it. He's giving me really good prices. It's basically giving the metal to me for spot price. And he's mainly got platinum and silver. Those are the two that he's got. So yeah, I'll take advantage of it. Andrew says 61% of Americans are living paycheck to paycheck. What are your best personal financial tips? Well, number one, don't live paycheck to paycheck. I can't do that, guys. I just can't unless I had to. Um, I feel like it's so dangerous. Someone at work, I was asking, like, he was thinking about moving up and buying a different truck. This was like a year or two ago. He's like, yeah, I'm thinking about buying a Tundra, and he already owns a Tacoma, which is pretty new. It's only a couple years old, at least at that time. And he's like, yeah, the Tundra, and something about the payments and all that stuff. I was like, well, how much do you have in savings? He's like, oh, I got plenty of savings. He has $2,000. And I'm like, $2,000? I would be crapping myself if I only had $2,000 in savings. So what I don't have it in my, I don't know, psychological capacity to live paycheck to paycheck. I just can't do it. Here's a couple of things that, I don't know, maybe shed some light. Somebody told me this. I can't remember where the quote's from. Someone said, you're gonna accept a job, or you're gonna accept pay that you are comfortable with. And what the problem with some people, they aren't comfortable living on $80,000 a year or $100,000 a year or even $200,000 a year. That is just not comfortable enough for them. So they continue to push, they continue to learn, they continue to either open up their own business, to flip homes, whatever the heck they're doing. And they go to a level to where they feel they're more comfortable with. And some people, they're never comfortable at the pay that they're getting. And I think that is one thing to kind of be aware of, is if you are living paycheck to paycheck and you're basically comfortable doing that, I think that's a problem. I think you need to be uncomfortable doing it. I think you should be uncomfortable. I mean, if you're living paycheck to paycheck and that's all the money you can make, then I would be highly uncomfortable and I would try everything in my power to make more income. That's what I would do. Whatever's in my control. Ask for a pay raise. Go find skill sets that I can learn. Go talk to my boss and say, "Hey, look, I'm unhappy. What can I do to increase my pay? What can I do to increase my level? What jobs can I learn the skill set for?" That's what I would do if I was unhappy with my pay. And that I think will always, help on the income side. But on the opposite side, if your expenses, if you're just frivolously spending, you got to stop doing that as well. If you're broke, then drive a broke car. If you're broke, then wear broke clothes. Like there's no gaining in life to wear to put up a facade of something that you're not. And if you're living paycheck to paycheck, irrespective of how much money you make, I just think that's a huge mistake. And I always feel best stacking money or stacking in investments, stacking silver, stacking gold, stacking whatever the heck it is, getting more shares in a company that I think is going to do well. And I want to participate in that company being successful. That's how I view it. I don't feel happy going and buying just stupid crap. I don't know. I just think it's just dumb. In fact, it makes me feel worse. It makes me feel cluttered. It makes me feel like there's crap around me that I need to clean up and throw away. Maybe that's just my lean 5S type stuff coming out, but that's my opinions on this. With the recent surge in oil demand, the U.S. government is now left with the petroleum reserve sufficient for only 16 days. There isn't much more pressure remaining from their end. In fact, this policy is gradually being reversed. Says the government recently announced the purchase of 6 million barrels, but later had to retract that decision, citing market conditions. It's worth noting that the recent oil rally began concurrently with the weekly change in petroleum reserves, shifting from deeply negative to zero. So here's the petroleum reserves. This is what they used to basically knock down the price of oil for a period of time. What's kind of interesting is Saudi Arabia is not going to allow them to buy oil from Saudi Arabia just so they can fill the reserves. They're like, I don't think so. Let's cut back the oil, bring the price back up, and they're going to have to pay a higher price, which, according to them, they're just going to wait, I think. I say, so is uranium going to fly this week? Question mark. I don't know, guys. I see a lot of breakouts in a lot of the charts. I get pretty bullish when I see that, and I obviously I don't know the future, but I'm pretty bullish uranium. If you didn't know, the FI couple, they say hidden expenses your rent covers. So there's a lot of people that come out here. They talk about people just don't know the full cost of ownership. And then they say, you've got property taxes, insurance costs, etc. Well, his response is, here's your hidden expenses that your rent covers. Property taxes, insurance, routine maintenance, future vacancy, owner's profit, property management, future repairs, and utilities. They are profiting off you. You are paying absorbent amounts of money when you rent. If I were renting the same house, I would be paying 3 times the amount to rent my house than what I did to buy it at the time that I purchased it and then when I refinanced. Rent is always going to go up. It is almost a sure thing that your rent is going to increase and increase and increase. And you know what? If you have a 30-year fixed rate mortgage in America, pretty sure your mortgage isn't going to go up as long as you stay in that house and you have that loan. So that also you can always refinance if rates were to go below your previous, your rate that you have on your mortgage. So you always have the option if that were to occur that rates were to drop to refinance. And that will lower your expenses. It won't increase your expenses. The time to do it is when the markets crash. That's generally when interest rates go down. And we're probably going to have some strength, I think, still for a while. I don't think things are going to crash, but if they were to crash, I think the market's going to come back and you could always refinance. That's what I'm going to say. The 14 research, it says the 2-10 yield curve has steepened by 35 basis points since July. Most of the steepening has been due to the 10-year rising, the bear steepener. Bear steepeners are rare and usually occur at two distinct points of the cycle, heading into recession, an inverted yield curve, and a new expansion positioning of the yield curve, positive yield curve. So right now we're coming back down. We're at a very low level for the yield curve. It doesn't mean it can't go lower like it did in the 1970s. These are bear steepeners out of a negative yield curve, generally led into a recession. 1990 was led by a housing market crash. This was also a housing market crash here. And this one was not a housing market crash, but a crash in the general system due to, we'll call it the tech bubble. So this one here, we had high inventory and we overbuilt and we had a crash. This was also an overbuilt condition. We crashed. This one was not an overbuilt condition, and this one also was not a overbuilt condition. But two of them were housing market crashes. One was weakness in the markets, and then this one was the COVID one that came on up. So I don't think if we are going to have a recession, I think it's going to mirror something like 2001. They're going to lower interest rates, and then I think the housing market's going to shoot up, and then rates will come back down. Just like this move here, this full cycle move from low to high to low. I think it'd do the same type of thing if it were to do it again. Staying consistent with dividend investing is one of the most rewarding things you can do for yourself because one day you'll wake up and realize that you don't need a salary anymore. And all of those years of contributing and reinvesting have finally paid off. There are a bunch of different dividends. I don't want to go into all of them, but you can make qualified dividends at lower tax rates instead of the cash dividends that are viewed as income. And dividends, you can live off them. They are part of the cash flow that gets paid out of a company. So the cash flow, they make some sort of cash flow. Sometimes they've got some sort of percent cash flow that they're going to pay out into dividends. And their cash flows are going to vary based off the commodity that they sell if it's a commodity company that's paying a dividend. PBR, they're paying next year 45% of cash flow in dividends. But if the price of oil goes up dramatically, they're also hopefully going to make a lot more cash flow. It says oil is already pricing in this massive decline in freight activity. While it is difficult to tell when freight demand will stabilize and recover, recent improvements in U.S. retail sales data are promising while recession expectations are peaking. So this is the recession expectations are peaking. You can see that we are actually rolling over for net percent saying recession is likely. That rolled over in March of 2009. That rolled over in April 2020. Maybe the slowdown has already occurred and it's behind us. I've said that once or twice before, and people are like, oh no, dude. Oh no. Yeah, in the comments section, whatever. It's like, maybe it has. Maybe it is already behind us. Maybe it's not. We're going to find out either way, but this is rolling over. And to me, I mean, maybe we strengthen from here. Tough to say. It sure looks like it because commodities are starting to take off. Copper might take off. A lot of these commodities are signaling that maybe we are strengthening up. Maybe just the lagging indicators haven't caught up yet, but we'll see. The median 401k balance for people aged 35 to 44 is only 28,318. It's a crisis. Also, 63% of Americans do not know how 401ks work. So here are 9 facts about 401ks that everyone should know. First, a 401k plan is a company-sponsored retirement account to which employees can contribute income, while employers may match contributions. There are 2 types of 401ks. There's a traditional and a Roth. The traditional 401k, your contributions are made pre-tax. So it reduces your taxable income. This means your taxable income is reduced and you can be reported as a tax deduction. Also, you pay no taxes on your contributions or growth until you withdraw. A Roth 401k, so with a Roth, your contributions are made after tax income. As a result, there is no tax deduction for the year, but your growth is tax-free when withdrawn at retirement. Not all employers offer a Roth option, so just check with HR to see what's available to you. And over my years, I have done a combination of Roth and traditional. Generally speaking, when I did it myself, and I'm not a tax advisor, I would contribute to a Roth when I had all my kids. And I just said, you know what? I'm probably at a low tax rate since I have all these write-offs. And I put a lot into the Roth 401k. So I have a lot of money in my 401k that's a Roth 401k. There's also another thing that you can do over here where it's a traditional pre-tax, and that depends on where you're at. But if you make a lot of money, you can put that in there pre-tax to lower your taxable income if you are making a lot of money at some point. You can also do a combination of both of them. You can do a traditional and a Roth. So that's kind of what you have there. And a Roth, if you can generate returns, if you can generate very good returns, a Roth 401k is a really good plan. Fact 3, a 401k is known as a defined contribution plan. Defined contribution basically means that it's up to you, the employee, to fund your retirement account instead of your employer. 401k is replacing pensions, which is a defined benefit plan. In short, it's up to you. Now here's your contribution limits. For the employee, the total amount that you can contribute is $22,500. That's pre-tax. That's pre-tax traditional money. For people 50 and older, you can add an extra $7,500. This is known as a catch-up contribution. If your employer also contributes, or if you elect to make additional non-deductible after-tax contributions, and if you're going to do that, you definitely want to put it in a Roth 401k. That's what I would do if it's available. To your traditional 401k account, there is a total employee and employer contribution amount for the year. So the max that you and your employer can put into your account is $61,000 for those under 50 and $73,500 for over 50. I think this number is wrong because I think it's $66,000 this year, if I can remember. I think this one was in 2022, not 2023. Because I do put a good amount in mine as well, and I'm very sure that that's the wrong number right here, just to let you know. Fact 5, how employer matching works. Okay, let's keep this simple. Let's say your employer match is 6%. This means that they will contribute up to 6% of your salary. If you make 50 grand, they'll put in 3,000. But this is if it's a dollar for dollar match. So if you do that, you have to put in at least 6% and they'll match 6%. You put in 3 grand, they'll match 3 grand. That right there is 100% return on your money. I would definitely do at least the minimum contribution there of matching. The most common type of match is a partial match or 50% match. In this case, your employer would only contribute 50% or half of the 3,000 or $1,500. Either way, this is free money, and this is one of the most powerful aspects of an employee-sponsored retirement account. You must invest the money in your 401k. Most plans will automatically default to investing in something like Target Date Fund. This is a great place to start, but it's ultimately up to you to determine if that's the right thing. Don't hesitate to reach out to a certified financial planner to make sure that you're invested in the right thing. This stuff is too important to not get checked out. Vesting periods. Vesting basically means ownership. If you leave your job and you're not 100% vested, you can take your contributions, but you can't take all of your employer's contributions. It's not employees, it's employer's contributions. Read the fine print when you start a new job. A typical vesting period is between 3 and 5 years, something to think about before leaving your job. Some learn this the hard way. You have 3 options for your 401k when you leave your job. You can withdraw the money, you can roll your 401k into an IRA, or you can leave it with your old employer. So let's go over each of those. Withdrawing the money. This is typically a bad idea unless you need the cash for an emergency. You'll be hit with an additional 10% early distribution tax unless you're over 59 and a half, permanently disabled, or meet the other IRS criteria for an exception to the rule. Roll your 401k into an IRA. When you do this, you avoid a tax bill. Also, you have access to more investment options. You can open up an IRA at Fidelity or Vanguard, and typically they have ways to help you do a rollover. And I've done a rollover. I've opened up stuff with Fidelity. Fidelity's been absolutely excellent, if you want my opinion there. Keep the 401k at the old employer. If you like the investment options at your old employer and it's well managed, then it might be worth keeping it there. Just don't forget about it. Some employers will force you to move it elsewhere depending on the balance. You can take out a 401k. Life happens. Sometimes a 401k feels like your only option. Just know that you will be taking money out and stopping the power of compounding. If you leave your job, you have while having a loan on your 401k, you'll have to pay it back within 60 days. If you don't pay it back, you'll likely face a deemed distribution and will pay penalties and income tax. This is something that if you talk about, best to avoid at all costs. In summary, your 401k is only part of your overall retirement puzzle, but an important part nonetheless. At the end of the day, just ensuring that you invest up to the match can go a long way. There are things that I've done in the past with 401ks. I've put a lot of money into 401ks to basically shelter money from taxes during certain periods of my life. I've put enough in there that you can also take a loan out against it. And what you do is you pay yourself back with interest. So you're basically avoiding taxes up front, putting a buttload of money in there, and then you can take a loan out if you wanted to buy something like another. Let's say it's a cash flow property that you want to basically get a loan for. You can take that out of your 401k. You can pay yourself back at interest, and that interest is the interest that you're paying yourself. And you can use that money for cash flow. And if you have a cash flow deal going on, maybe maybe here's an example. I'll just give you an example of what I could do. So let's say you're at a high tax bracket. You're at like a 30 or 30 something percent tax bracket that you're making a lot of money. You dump a whole bunch of money into your 401k. And there's an opportunity that comes up that can cash flow you a lot of money. And you've got a large 401k account balance. Let's say you've got like $1 million in there or something like that. So you're like, okay, I'll take a loan out of 20 or 40,000 or something like that. And you buy this cash flow thing, and then you pay yourself back with the cash flow that it's generating. So now you're generating more cash in the system. You've diversified your investment into something else, and now you're paying that all back. I don't view that as a bad problem. Now, if you're using your 401k to finance a car or something like that, I just don't think that's a good idea. If your goal is to retire, you could use it, I guess, if you had a problem or a crunch with cash flow or something like that. That is a potential possibility. But again, you're going to have to pay that back to yourself, or you're going to get hit with a distribution, which is going to cost. It's going to cost some money in terms of taxes. So that's just my take around it. Take it for whatever it's worth. It says no amount of evidence will ever convince an idiot. It says once I pay my mortgage, I live free forever. That's what most people think. But don't forget property taxes, insurance, maintenance. Guys, if I was renting, I would be just it would be hurting right now. It would be hurting. There's very few places to rent, and they are all very expensive. I did very well buying when I did, and it was on purpose, completely, refinanced when I should have. I did everything I could to make that an active decision in my life. And now I'm reaping the rewards and benefits of it. I'm not trying to brag. It's just if you know the cycle, if you know what's coming, you could set yourself up way better than you would if you never knew that stuff was coming. It says if people spent more time in dugouts, locker rooms, and trading floors, maybe they wouldn't be such pansies. No one cares. Do better. So, serious question: people with thick skin, how do you condition yourself to be that way? I, you know, I, I know that it looks like it's coming from a female. What I'm going to say is, guys run into this a lot in their life. So I think it's more on the female side. I think females get treated different from their parents, from just regular people. Guys treat females different, and guys treating guys. I played a lot of sports, and I would say I got yelled at all the time. like like it was just nonstop. When I was a little kid, if you're running the wrong play, you're getting yelled at. If you're not trying your hardest, you're getting yelled at. If you didn't make the correct tackle or hit, you're getting yelled at. If you didn't pick up the ground ball, you're getting yelled at. If you didn't throw it to the right base, you're getting yelled at. I mean, at some point, like I don't even know if people are yelling at me because it just doesn't phase me. And I don't know if that's because I was just on all these different sports teams that all the coaches and stuff were just yelling at all the kids, and you just become immune to it, like that's normal. I don't think girls get yelled at as much. And I'm not trying to make this like a guy girl thing, but if it seems like people who aren't in sports or they're not in maybe really competitive things, they just don't get yelled at and they don't have those difficult conflicts to really overcome. I mean, you're going to get yelled at by other players. If you're not doing your job and you're on a highly competitive team, you're going to get yelled at. If you're not blocking a guy and the guy that's behind you, and if you're playing on really competitive teams, some of these guys are worth tens of millions of dollars or hundreds of millions of dollars on your team. They're going to get up your ass if you're not doing it. I mean, they're going to be on you, and that's just part of being in a highly competitive environment. Most businesses are not that competitive. I would say they're pretty woke and kind of not competitive at all. But I've been on some teams where you've got, four, five, six pro players, hockey especially, and you know, even younger kids, 14, 15, 16 years old, sometimes they can get pretty competitive. And even the parents are competitive. They'll start fights in the stands if the game gets, we'll say, pretty rough. Some cheap shots going down, and if you take a cheap shot, you're just gonna say, you know what, I'll get them next shift. It's the way it is. I just don't think a lot of people have that type of experience, and that's the way. That's how I played. It's like I'm not gonna do a cheap shot back, but number whatever 15. I got your number, dude. Like next time I see you and you got the puck, you better get ready. It says, when you win the 1.5 billion Mega Millions lottery jackpot, what are you doing this weekend? I thought a lot about this, and every time I think about it, I think what I'm going to do is I'm just going to sleep in. It's really what I'm going to do. I'm going to sleep in. I'm going to catch up on any sleep that I'm not getting because I work, jobs and stuff like that. I think I'm just going to sleep in. I'm not even going to worry about work. Like that's done. Like 1.5 billion, that's ridiculous. But I'm going to sleep in. I'm going to take it easy, and then maybe I'll think about where I might want to live, what that looks like. I may even call a tax specialist and say, how do I claim this thing to pay the least amount in taxes? Do I claim it as an individual? Do I claim it as a like in a trust or something like that? I don't even know. I'd have to really talk to someone and say, how would I do this? So, I mean, that's really probably what I would do is just relax, figure out how to claim the thing, and just take it one step at a time. That's my thought process. I wouldn't even tell anyone I won. I wouldn't even tell work. I just wouldn't show up. I mean, I just wouldn't do anything. I'd be real secretive about it, and then I'd probably claim it under a trust or something like that, and it'd probably be something that is unnamed, so people couldn't contact me or whatever. Gary says, since the secular bear market bottom in '01, and despite being well off the all-time highs, silver is still massively outperforming the rest of the metals complex. In fact, silver is even massively outperforming the NASDAQ during that period. I see traders getting frustrated because the metals, and especially silver, aren't moving fast enough for them. Don't be stupid. Now is the time to be accumulating. By the time we get to the bubble top in 2 to 6 years, silver will have made everything else look pitiful. I'll say it again, $100 silver is going to be a piece of cake. 250 silver isn't out of the question, and 500 silver is possible during the final 6 to 8 weeks of a truly manic bubble phase. So here's gold up 650% from the year 2000. It has beat a lot of the major indices and indexes during that same time frame. It's probably going to decimate it when this thing really starts to move. The miners are up only 200%. So we've got gold up 650, miners up 200%, and silver from 2000 is up 1800%. So I know that seems weird, and people are like, well, the thing I also want to talk about here is how much risk did you have to take to buy gold and to buy physical silver and be up this amount? What risk are you really taking? Do you think a coup is going to impact the price of silver in a negative way? No. Do you think there's any management risk, higher taxes from the operation? If a commodity goes ways up and the company is making more money, they're going to get taxed more. I guarantee the government's going to come in there and try to do some sort of stupid, tax. There's royalties on some of these, miners and stuff like that. So I always look at the metals and I'm like, man, this is such a low risk approach. Why don't I just buy a whole crap ton of it? And that's usually what I do. I just buy a crap ton of it and just keep holding on. And I'm going to end it there, guys. So that's what we've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. But that's what we've got for today. I don't really have any more comments to comment on. Next Platinum question and answer session is at 5 p.m. on Sunday. Love to have you there. Love to have you guys talk about and ask questions. We generally go over similar things most of the times. We go over individual companies that I see up against resistances that are about to break, good setups. And yeah, that's what we've got for today. So we'll catch you next time. This is Finding Value.